Imagine leaving a crisp new bill on your kitchen counter, only to come back a year later and find the edges crumbling away. That silent decay happens to our savings every day. It's called inflation. In simple terms, it means the everyday items you buy are getting more expensive over time. Let's look at this diagram. Right now, this apple costs exactly 1 coin. Fast forward a year, that exact same apple requires your original coin plus a fraction more. So today, your single original coin only gets you part of the apple. When your money sits completely still in a standard checking account, it actually loses ground. Governments and financial institutions around the world are constantly trying to counteract this invisible drain on their citizens' savings. We recently saw a clear example of this in Egypt. 2 major institutions, the National Bank of Egypt and Bank Miss, made headlines by raising the interest rates on their savings certificates to nearly 20%. Why would these massive banks volunteer to pay such high rewards to everyday savers? And what can anyone, anywhere in the world, learn from how they did it? To understand their strategy, we need to look at the tool they used, a savings certificate, which is also called a certificate of deposit in some regions. Think of it like lending a lump sum of money to a friend. You hand over the cash, and they agree to return it in full after a few years. In exchange for the favor, the bank gives you a monthly bonus. There is a catch. You agree not to touch or withdraw your original money while that countdown timer is ticking, unless you are willing to pay a penalty fee. So a savings certificate trades your patience and temporary lack of access for a steady, guaranteed financial profit. In the recent Egyptian banking updates, these institutions offered 2 distinct options for these certificates, fixed and variable. Here is a graph showing the fixed rate option. It works a lot like signing a lease for an apartment. On day 1, you lock in a specific percentage, and the line stays perfectly flat. No matter how stormy the broader economy gets, your monthly payout stays exactly the same. Now, look at the right side for the variable rate option. This is closer to surge pricing in a rideshare app, where the return rate floats, waving up and down based on the central bank. It might start at a higher payout on day 1, but it will dip or surge depending on the overall financial weather forecast. Choosing between fixed and variable isn't about finding a secret perfect product. It comes down to whether you prefer complete certainty or are willing to ride the economic waves for a potentially higher return. But why would these mega banks voluntarily offer everyday savers almost 20% interest just to hold their money? To fund massive multi-year projects like new factories or roads, they need a steady, predictable supply of cash that they know will stay put in the vault for a long time. By raising the reward on these specific certificates, banks give citizens a strong reason to save. This helps cool down inflation, while keeping the official national interest rate dial in a safe, green, neutral zone. If the central bank had just raised the national interest rate instead, it would place a crushing weight on the economy. Borrowing money for a regular home mortgage or a small business loan would suddenly become devastatingly expensive. High-yield savings certificates act as a targeted economic shield. They protect the savings of everyday people without accidentally stalling the broader economy's ability to grow. We can take the lessons from these massive financial institutions and apply them directly to our own wallets. Rule 1 is simple: never leave your cash idle. Time and inflation will quietly consume the value of money in a basic checking account. Rule 2 is to assess your personal risk tolerance. Decide if the peace of mind from a fixed rate or the potential boost of a variable rate fits your goals better. Right now, check the interest rate your bank pays on your savings. Then, look up your country's current inflation rate. If your local inflation rate is higher than your savings rate, you are slowly losing your buying power. It is worth researching certificates of deposit or high-yield accounts available in your area to close that gap. Protecting your wealth doesn't require risky stock market bets. It just requires putting your idle money to work so that it can actively outpace the rising cost of living. If you found this helpful, subscribe for more ways to optimize your personal finances.